Okay, fantastic. Welcome, everyone. We are back with Financial Fox Smart Investing with the gurus, Zach Meir and Clem Chambers. We know that Clem is a bit busy with what is going on at ADVFN, so he's going to be joining very shortly. But we can't talk too much when he comes in, isn't it, Zach?
I'm still dying to hear what he's going to say.
I'm still trying to digest, a mogul of the retail investor space, like ADVFN is getting into, this kind of action, which, is interesting to see. Anyway, let's talk a bit about the Fed and the meeting yesterday and their attitude. Yeah, we are going to raise rates, but we are not going to do that yet. So it's kind of like a bit confusing in a way. So what are you expecting really? Or, just share with us some of your impression from the meeting.
Well, the first impression is that, first thing is that this raising rates and inflation thing, all that did in the 20th century was cause boom and bust. I don't think that's the right way to regulate the economy anyway. And I think it's quite idiotic. And the reason that we had a 20-year period of, relative stability was, there wasn't any economic crash. There might have been other nightmares, but that, we had economic stability. We didn't, we hardly had any recessions or anything else. It was the central banks didn't do this throwing the baby out with the bathwater with inflation, with interest rate rises. I just don't think central banks or governments are really good at regulating economies. They should really be allowed to be as free as they can be. Also, inflation 5% is probably the ideal inflation rate for an economy. Gives companies pricing power. It creates a sort of flow of money. I think it's, it would actually be even better if you could get 5% on deposit in the bank as well. So I think that if they don't pass on interest rate rises, that will also be a bit of it will be a total con, in fact. I don't think the interest rate rise that we had here, none of it was passed on by the banks. And so that has to be addressed. But I think in general, I don't agree with interest rates being used as a economic regulator. And the second main point, though, is that while the Fed are flagging the interest rate rises, if we had a stock market like we had at the beginning of the week with a 2%, 3% fall, I can assure you, and the Dow fell, I don't know, 10, 20% from where it is now, I can assure you that they wouldn't be raising rates at all. And they would, they would say the economic situation doesn't look very sound and we are not going to raise rates. So I think it's a bluff. I think in general, the market thinks it's a bluff. Also, obviously, some in the market now are so young that they don't actually know what happens in a rising interest rate cycle. But I don't think the economies anywhere are strong enough to have interest rate rises, and we'll probably have more pandemic or scamdemic scares.
There is a new subvariant. Did you heard of that?
I don't care about any of these variants. I think that we've, with the Omicron, finished the whole thing. And I think, I'm not an anti-vaxxer. I've had all three poisonous vaccines and we're still alive, apparently. So I'm not an anti-vaxxer, but I think the economies are not strong enough for interest rate rises, and that would be a mistake. And so I think that's that point. But as usual, as we've had it since since 2008, anytime the central banks get serious about raising interest rates, the stock market starts to collapse, and then they have to do a U-turn. And I expect them to do that now. And it's just not the right thing to do anyway. I mean, if you want to control these things, you should do it through taxation or some other means, but not through interest rate.
They are already increasing tax, Zach. They are increasing tax from, I think it's from this year, actually.
Well, no. Well, I mean, obviously, in this country, the taxes, I think, were the highest it's been for sort of decades. So I take your point, but I think if you tax people to death already, having interest rate rises, potentially collapsing the property market, the housing market, which is still the government's main weapon of wealth creation would also be madness. Just imagine if interest rates went to 5 or 6 or 7%, and people who bought with a 1% interest rate had to pay all that. It would be calamitous. So I think there's no way of getting out of this this issue. Raising rates would collapse the housing market, which would cause real damage. And I don't think in general it's a good thing to do. So it's unfortunate that I'm not in government, but maybe that'll come too. But these policies, I think, are just very 20th century, very blunt instrument, and very wrong.
So basically, do you see that kind of Fed decision and policy very tied up with the stock market? So if they're actually going to go ahead with the rise of interest rate, the stock market, it can fall further, and how much it can actually fall?
Well, I think obviously it can fall to any amount, maybe temporarily. We've had flash crashes. Obviously, 2008 there was a pretty significant fall. There've been smaller falls in the recent past. Obviously, earlier in the week the Dow was down 1,000 points and then managed to close up on the day. I think that kind of price action shows a market which is actually still pretty strong. And as I said, I think that I think at this stage people don't really believe there's going to be interest rate rises, or if there are, they won't have that effect on the stock market or on companies. And so I think companies in general are probably going to start doing rather well, but the cabin fever of people going out and about and spending money in hospitality and other areas. So hopefully that will be a boom. And I think that if inflation is the price to pay for getting back to normality, I think it's a price worth paying.
Right, and that basically. So if we use the scenario where inflation is there, the stock market is not going to go down, but it probably is going to go sideways or perhaps go up, and that will be the way that people are going to make up the loss in the consumer power.
Yeah, I mean, I think the thing that would be really damaging, which hasn't been mentioned because it's sort of like stock market and inflation, stock market and interest rates. But interest rates, the housing market would just, in a way, I'm more concerned about the housing market collapsing rather than the stock market collapsing, because I think companies in general they've got through the pandemic, and I think they'll have the corporate side will actually do rather well. But it's the housing market that people are overgeared and have bought buy to let or buy to rent and all those sorts of things. Those are the people who could be really vulnerable. If your shopping bill goes up, but then your interest rates, your mortgage rate or interest payments go up, that would be suicidal for any government to do. And so I don't think that can be done, and I think it's a bluff.
Okay, talking about stock market, and then I want to go into crypto because they also experience quite a significant fall connected to the macro, but also something that is going on in the crypto space. So we talk with Clem that is joining in 5 minutes. So let's maybe look back at the market, and you always kind of give us some little gems or some company to look for or something you are excited about. Anything happened this week that you think it would be worthwhile for investors to have a look at or to research on?
No, I think the highlight for me this week was probably the way that Bitcoin bounced, I think 33,000, something like that. And there is an uptrend line from last year on Bitcoin from going through that level. I did a video on it, and I've done a couple of videos on it actually. And for me, if that line holds, and I'm expecting the 33,000, 35,000 level to hold, in a way that would and should be a great level if you like the crypto space to get in. I think that's we're down from 68,000 to 33, so that's a pretty hefty decline.
But what about if it goes even down to 20,000? Or I mean, I'm not saying 10,000. I don't want to be so bearish when I'm a pro crypto. But I think I do see your point, but where is going to be the bottom line?
No, the bottom line is at 33,000. That's the bottom line. We bounced off that.
So
I think that is. I mean, that for me is if that holds 33,000, then the glass is half full, and is not and remains half full. Anything below 33,000, or say we start going 30 or 29, and I would just say that you know, the correction that we've had since the autumn is actually, you know, there's something wrong, and it's not just another dip to buy into. Obviously, there have been many dips to buy into over the last year. I think the last time was just below 30,000, and the 33 I think makes sense. And as long as we hold above that low 30s area, I think we're fine. And there's nothing wrong at all with the house of crypto. You know, everything should, you know, in the long term, it's going to make it. The threats are obviously all the regulatory things, but the definition of crypto, one of the definitions of crypto, I think, is that it's, you know, you can't regulate it, and that's the whole.
I know.
The whole good.
I know your stance.
And so they'll never be able to regulate it, and I'm delighted with that. They created a monster. The center, you know,
them all. That's it. The monster that will eat the Fed.
Yeah, I mean, basically, crypto is a result of over-regulated and idiotically regulated financial markets, and I'm quite familiar with how they work. They were sort of guilty until proven innocent, and all the other the negative assumptions they have. They're run by people who are normally jealous, bitter, and twisted, or have nothing else to do. And so it doesn't
just tell other people what to do. Exactly.
They tell other people what to do, which is fine because everybody deserves to have a living. But the reason that we have crypto is because of over-regulated markets. Actually, from the time of 2008, when the global financial crisis happened, the whole regulation became draconian, and it's even more draconian now. We got MiFID and all these other things that the EU gave us, and we're just still taking them. And therefore, there's no way, apart from, you know, the totalitarian countries like China, etc., can regulate them. But I suppose even there, I don't think it's going to be that they're going to get much traction out of regular. You know, people just send their mother's money somewhere else or find a way around it. So crypto, I think, will remain unregulated, and that's the whole point of it. And I think that above 33,000 or that area, if it's going to be a buying opportunity and if it's going to be a long-term winner, and you like crypto, that would be the area to go for. And as we're relatively near to that, I think you know, that's the opportunity this week.
Okay, so right, let me just bring up the chart of Bitcoin, because I want you to expand on that. So here we are. Okay, so let's maybe do like a 3 years chart, or even less, 2 years chart. That's it. Right. So the support is 30,000, 31,000.
Yeah, but there's, I mean, that's a sort of a line chart. But if you have a bar chart, it doesn't really matter now. But there's a line from the beginning of I think either last year or I think from the beginning of last year, going through the low of last year, and then that meeting the price from earlier this week. So that's that. I think the other point to note is that basically you know, people are saying that, you know, Bitcoin is not a store of value, et cetera, and that, you know, when liquidity comes out of the market, people liquidate Bitcoin. I think that's understandable, but obviously it's gone up so much. It's always going to be understandable that people would sell out of Bitcoin to cover losses in other markets, because obviously that's the way that.
Yeah, but also something crazy has been happening. Like, you know, we see the IMF that is basically urging El Salvador to leave Bitcoin as a legal tender, because that's crazy, and they are already, you know, not in such a.
But who are the IMF?
Exactly, but it's the same people, the one they don't know what to do, and they tell you what to do, right?
Who voted for the IMF? Who voted for who voted for the World Health Organization either? But you've got all these Quango organizations, and then at the same time you have all the the mainstream media also delighting every time Bitcoin and the cryptos go down. And when it goes up, they're sort of that they get rather upset and say, oh, it's all a bubble. So you have that again, that sort of slightly jealous, envious type of reporting, delighting in the falls in the market, which actually you get even with the Dow's down 1,000 points. Oh my God, it's the end of the world. But I think the way that markets are reported and the type of people who report them also doesn't that doesn't help. I think on Monday when the market was down, all the sort of the main newspapers were saying, oh, it's a crash and it's all over and everything else. And by the end of the day, the Dow was actually up on it was the biggest turnaround in 100 years or something. And so I think that is something. If there is a tip, it is to actually almost like when there's a big move on the market like that, or on the downside in particular, those are always the best. They're always the best times to buy. I mean, it really is. And crypto was like that this week. I mean, at the beginning of the week, you had the Dow down 1,000 points. You had Bitcoin at 33,000. Whenever you see the sort of the in the papers saying, "Oh, crypto's over, it's finished," the stock market's finished because of inflation and interest rate rises, it's always the time to buy. And in fact, if you want to go back, because I can remember back, the stock market doesn't actually normally get hurt by interest rate rises until about 6 months to a year after the rates start going up. So, on that basis, we would probably still have a good 2022 if the Fed were mad enough to raise rates, which I don't think they'll be able to do, or too chicken to do. And so, there are rules in terms of all that. One rule is obviously, when you see negative newspaper stories, you buy the day after normally. And the other one is that there's always a delay in the market falling after interest rates. At the same time, the other way around, when they start lowering interest rates, there's a delay of 6 months to a year as well. So, I think there's a lot of opportunity if you've got that longer term perspective, or if you realize the game that's being played. I mean, it is if you think about it anyway, after the pandemic is literally the worst time to raise rates. I mean, why are we doing it now?
Clem, why are we doing it now?
Hi. Well, I mean, I think that there's a very like the glasses. I think there's a very strong political reason, because everybody's looking at this gigantic balance sheet that the Fed has, which is trillions and trillions and trillions, and can't remember the number. It's something like 60% of GDP in their balance sheet. Now, there's good news and bad news. The good news is the so-called tightening that's going to go on will be to suck out the excess cash in the system, which is being banked with the Fed itself every night from the banking system. And that's about $1.7 trillion. So they will pull that cash out of the market. So they'll pull it out from the margin, and then that will suck it out from the banking system, who are lodging it with the Fed because they got nothing to do with it, nowhere to put it. Okay, so they pump cash in, it's gone into the banks. The banks go, "Oh, this cash," and they stick it with the Fed, and that's the loop. And that's about $1.7 trillion of excess money in the system. Now, therefore, they can bring their balance sheet down by 1.7 trillion by sucking that cash out back into them through bonds, etc. So they'll suck that out by tightening, and then when it's gone, or when it's nearly gone, or when the drop in bank reserves is such that everybody starts to get a bit squeaky and starts to say to people, "No, we're not lending you the money. No, you can't have any more money," they'll then stop. Now, of course, that's all well and good. That sounds great on paper. They're just going to turn the knob and everything's going to be fine. But the bad news, I think, is they're going to want to bury the idea that there's a Fed put, i.e. that the Fed will always step in and buy at a certain price and save everybody from making losses. And by doing so, create this huge moral jeopardy, which says, we don't care how stupid you are and how much wildly you gamble, we'll always save you.
Exactly.
So I think it's quite possible that they'll let the market teach everybody a lesson about now, with something that looks almost like a crash, i.e. a 20% drop. And
they won't do. I don't think I know what you mean, and I think you're absolutely right in what you're the contents of what you're saying, but I just don't think that politically they can do that we're in a nanny state on every single front, and the Fed put and the moral hazard and all the other stuff. I mean, that ship sailed at least 14 years ago, and it remains very much in cruise mode at the moment. So I just don't think it's going to happen at all.
I think that's a solid call, but I think there's a possibility that they won't encourage people to up their risk profile. In fact, they'll discourage people upping their risk profile, and that in itself will look at a vastly overvalued market in the US, and certainly top it out. And I think what they'll be aiming for is what they got after 2000 with the dot-com crash in the Dow, which is a period of many years of sideways trading, quite jagged sideways trading, which will be a whipsaw. So, it's kind of like, do you buy the dip? Probably it's good if you've got enough nerve to buy big drawdowns, 10, 12% drawdowns, and then enough confidence to sell out when there's a kind of recovery back to that range. Then I think that's probably a good strategy. For me, I think that they could get a runaway, because I'm sorry, I don't see companies worth 3 trillion as something that's anything but the palace in Tokyo being worth more than all the real estate in America in '89.
I disagree. But apparently there are more iPhones sold every minute than there are babies born. I mean, that's got to be worth 3 trillion, isn't it?
Yeah, because we are in climate change. There is no problem about climate. That's why you don't have to.
There's no problem about climate at all. It changes all the time.
We have to preserve the people. They're going to the moon, in space investing. They're trying to get water, moon mining. That's the coolest stuff.
I don't think there's that much shortage on Earth of water that they want to get it from the moon. But I mean, outside of all that, I mean, I think the best way to make money in the market is to buy low and sell high. Well, it's certainly high in America.
Yeah. Okay, Clem, here is the question. Are we seeing tech stock valuation as high as they were in the dot-com boom now, or not yet? So the crash, it might not be the same.
If you look at the dot-com boom, the kind of top for all the superstars was $200 to $400 billion. And now it's 10 times higher. Well, to get 10 times higher in 20 years is quite I think it's, quite a large compound rate of interest. So if these things were around one and a bit trillion, I could say, yeah, okay, that's not too uncomfortable. But I'm sorry, if you look at Apple and you look at the number of people that can afford an Apple, it's basically their market cap is one of their phone products per person on Earth. And so I'm old, there's too many zeros. And I think we've already seen a big fat correction. It's already there. It's already happened. And if you take out all those megastars and you look at everything below that, this is some ridiculous number, like 40% of companies are down by half, or that a lot of the SPACs got killed, cannabis got killed, the farmers got killed, everybody got killed, all the way up to the superstars, and now they're taking the beating. So
I think that's a very good point. I think that's a very good point. I mean, that's the other thing that we're told that we're in a massive bubble and everything else, but actually, it's I think the whole thing is pretty well regulated, and the market, just a bit like the crypto area. We had the bubble move to 68,000. Well, it corrected itself without any of the Fed or anybody else chipping in. It was just the market, buyers and sellers fighting it out. It worked very well, and we're probably at a level, in the 30,000s, which is much more sustainable, and it could stay in this area for the next year or 2 years. So I think let the market do these things. Same with inflation, and same with the other things. Why does the government always have to intervene? If inflation went up too much, then people would.
I can help you there. I can help you there. The government has to intervene because that is what they do. That's their purpose in life, in the world. That's what a government's purpose is.
No, it's like a scorpion stinging. They can't help but do it, and they can't help but do it even when there's no reason to do it. They just have to keep on doing it.
Well, yes, they have to do it because that's their whole purpose of being of existence. That they do it too much is another matter. And
there's no there's no reverse. There's no bonfire of rules. It's like now with the face mask, right? Well, for the next 100 years, every time you get on a plane, we'll be having face masks, and they'll check your shoes and they'll do all the things which were a once-off, but then they became mandatory. Yeah. There's never any bonfire of the regulations. It's always more and more and more added on, like a sort of overloaded donkey. And so, that's the problem. And the thing is now, this is the best time for the government not to do anything and let the market settle down after the pandemic. But no, they've got to go in there and just start fiddling and messing things about.
Clem, Zach he's suggesting that we have reached kind of the support level for or resistance. Oh, help me on that. Support, exactly. I always get mixed up. I'm not a chartist, but the support level for Bitcoin. Are you comfortable with that, or do you think we are going to drop further? Or
see you at 20.
Okay, why? That's it. It's a race now.
Maybe see you at 14.
I'm gonna say I didn't want to say 10 because I said I'm
probably gets to 20,000. I'll buy you a pint, Clem.
Okay. Can you afford it?
And if it gets to 60,000, you can buy me a pint.
Well, that'll be in 4 years, and I don't mind buying you a pint in 4 years.
It might be.
I mean, look. I mean, I don't mean to be a broken record, but I was saying this when it peaked. I mean, the peak of Bitcoin was about 32,000. Then in came the institutions, or some institutions, with crazy FOMO, and then off it went. And then, okay, so there was an extra run, and that was great because you could do really well in DeFi, as you did, Stefan, as I did. And then it came down, and that was going to be the crash that was going to bring it down to 15,000. And then out pops China with its social clampdown, which, in comparison with the pain in the anatomy that we suffer here is nothing in comparison with what goes on there. They did a social clampdown where you're not allowed to have boy bands that wear pink, and you're not allowed to play computer games apart from on the weekend for 1 hour, and you're not allowed to you've got to go out and be fit at school and all that stuff. You're not allowed to learn English now and all that. And then bang, up went Bitcoin, and Afghanistan, bang, up went Bitcoin. Well, that's all gone now. And now it's coming back down that slope that it would have come down if the Chinese clamped down and Afghanistan hadn't. And that takes it down to 20 and less. That's my thesis. Okay. And, with something could come up. I mean, Ukraine could get invaded tomorrow and bang, up and go Bitcoin again. But outside of those exogenous, which is a word I like, it's a new one, it makes me sound clever. Okay. Outside of those exogenous occurrences, those one-offs, those unknowables, it's going down. And then it's going to get a bottom, and it's going to sit on the bottom for 18 months, 2 years, or however long it takes. And then there'll be a halving, and bang, up it will go again.
So what about people do now? Traders, they want to get into crypto. I mean, if it's not a good time to...
No, I don't think that's right. I don't think that's right. I don't think at the moment people want to get into crypto at all. I think the interest in crypto has subsided significantly. And if you want to check that, go onto Google Trends and just type in Bitcoin and tell me what the world thinks about level of interest at the moment. I mean, I do note that today I could actually afford to do Ethereum transactions. So, and the Ethereum transactions are way down from where they have been up to recently. I was looking for bank holidays to explain that one. But, if the interest drops because, the FOMO's dead now, and it might go into reverse, fear of getting involved. What's that? Foggy. Involved. It'll be foggy. We just invented a new acronym, foggy, fear of getting involved. Yeah. So I think we're now in foggy and not FOMO. And, that's going to be a drag. But I said it only takes one crazy thing to happen for it to go off. And you can see that now people are considering it a high beta financial instrument, so that when it goes up, so do equities, or when equities go up, it goes up. And when old JP says, oh no, quantitative tightening, it goes thump. And then when he says, oh, maybe not so much. Thump. So, you know, it is a high beta risk asset that people who want to be on the margin of embracing risk to get better alpha are using as a way to, you know, steer around risk on, risk off.
But
which
then
I think relatively brave.
But then we see the foggy also in the stock market, because people don't want to get involved because valuations are too high, stocks are going down, they are so volatile depending on what the Fed said or
Well,
they
I mean,
don't say.
I do think you have to be a little bit, you know, living under a rock to not imagine that all this free money is stopped now. And, you know, it's the free money that drove that V-shaped bottom. I mean, when it crashed, I went on and said, V-shaped bottoms, no, never going to happen. They're really very, very, very rare. Well, we got a kind of V-shaped bottom. It went bang, bang, and then it did a little bit of a W, and then off it went again. But, you know, if anybody thinks that's natural, when you get a pandemic that doesn't kill 20% of your population, but kills 20% of your population's wealth and generates huge amounts of inflation and all sorts of situations that have to be reversed out of very, very under great difficulty, then, you know, you can see that the downside is a lot further down. But the only reason it's not down there is because inflation is pushing the nominal values up. So, you know, there's this tension between inflation driving prices up and loss of wealth driving nominal prices down. And they're far from being balanced. And if you look at a lot of the charts, what you're seeing is volatility, crash, bang, ooh, rather than brrr, as it was before.
Yeah.
So the market is unsure. Now that's bearish, because when the market's unsure, it doesn't want to take risk. It doesn't want to plow its money in. It doesn't want to be buying. So I think it's a very bearish picture, but possibly just in the short term, because I think the risk is not the certainty. The risk is there's going to be a very strong correction, not a crash. And then, you know, at that point, we'll see where we are.
Okay, so in the meantime, what people do, they just sat on cash, or they do some DeFi and earn the little interest they can earn that is better than what they have got in the bank, or they just don't do anything.
Well,
or they hold.
Capital protection is the first order. You don't want to, you know, if you're the sort of person that goes into the market and buys kangaroo dung, oil and gas,
Love that.
you're going to lose all your money, aren't you? So you know, you might as well carry on losing all your money. But if you're there to actually you know, build up capital, then it's about managing your risk profile. And when you're scared, you shouldn't be there. And when you're not scared, you should be. And when it's low, you should buy, and when it's high, you should sell. And all that boring stuff that people don't want to hear about, you know, all the stuff that isn't, kangaroo dung, oil and gas is in Antarctica, and they've got a mountain of guano, and they're going to, you know, fire it in rockets onto fields, and they're going to make $1 trillion. If you want to hear about, you know, all those things, then why would you stop? And that's the quite often the trading game, so-called trading game. But as far as investment goes, I mean, you've got to have real rose-colored glasses to imagine it's going to be that much of a strong market this year. Yeah. And, you know, you don't have to have them too rosy to see that the Fed can do QT and drain that 1.7 trillion out and get applaud from the audience. Oh, well done. You brought your balance sheet down by nearly 2 trillion. Well done. And they'll go, yes, it makes no difference. But I'm glad you're happy about that. Because remember, they had the Build Back Better, whatever the last one was 1.5 trillion of new money. And they all went, oh, we're not going to do that now. It's their fault. It's their fault. All you poor people that was going to get a handout, you're not going to get it now, but it's not my fault. It's his fault. It's their fault. Nothing to do with us. But funny how it didn't happen. And that's because even the Democrats who, you know, like to buy votes realize that if they pumped another 1.5 trillion down the toilet, there was, you know, really bad things ahead. I mean, they're not as crazy and feckless as they come across. They are pretty smart people. That's why they're in politics. But, you know, even the most feckless of them can see that, you know, they don't want to keep printing money because the wheels will come off. And the wheels aren't going to come off, but we are going to get high inflation. And that fits in with what Zach says. they can't afford not to do it. Well, they can and they can't. They can afford to spread it for over quite a long time. And that's what they'll spread 7 or 8% over the next 3 or 4 years. And at the end of that period, GDP would be back in line with debt, and their tax catch would be back in good shape, and everybody will still be licking their wounds, but nonetheless, it will be all back on an even keel, subject to COVID not popping up,
Exactly.
subject to Ukraine not being invaded by Russia, subject to not getting hit by a meteorite, etc., etc., etc.
Yeah. Subject to crypto coming up with something quite strong. I mean, if Bitcoin over the next couple, let's say 4 years, it goes up to 500,000, for example.
I've got to put my glasses on because your glasses are so good. You're outcompeting me in the superstar scales. So there we are. This is my Elton John look. Now, the thing about crypto is that it's not all about Bitcoin. It is, Bitcoin is the £800 gorilla, and if you want to back crypto, you might as well back Bitcoin and maybe Ethereum. And that when you go down from Bitcoin, you have to think harder about where you're putting your money and why. Okay, but there's all these developments going on, as you're seeing, and there's a ton going on in NFTs, and I don't mean bored kangaroo dung.
No.
Club.
Real utilities, yeah,
real utilities, and that is just one of the things, and there'll be more. In 3 months, there'll be something else, and you go, oh, blast! I missed that. I missed the anti-gravity crypto. Oh no, I should have got into the deep sea oil drilling crypto or whatever. These new use cases will be popping up, and there will be good money. It will be a good thing to stake out, because they probably won't go ballistic overnight, because they sit there in the crypto winter in the fridge. But when the spring comes, they will explode. And so anything new beyond NFT, I mean, the metaverse is one, but there'll be something else in addition to the metaverse.
Yeah.
It will pop up in 90 days time, because it just will. I don't know what it is, but it will pop up. And I will look at it and I'll go, I don't understand. My brain hurts. What's that? No, that's silly, that is. Oh, wow. Oh, that's what it is it? Oh, I better buy some of that. And then probably 120 days later, 6 months later, there'll be another one. That'll be different. So that's the game to play during the crypto winter. Get your positions in for the crypto spring and summer, which will come in a couple of years.
So keep researching, keep keeping your eye on, keep listening. A good people talking like you, Clem, and you giving us some good tips as well.
Well, I've got a great tip for you right now.
Okay, go on.
And I was taught this by my father, who was a big commodity speculator in the 70s. And I was being taken to school or somewhere, and I said, Dad, how do you make all this money in commodities? And he said, it's very simple, son. You buy it cheap when it's really, really cheap, and then it goes up. And then when it goes up a lot, you then sell. And I said, oh, okay, but how do you know? And he said, well, there's only one thing you got to know. Is it going up or is it going down? That's all you got to know. Is it going up or is it going down? And I thought, as a 9-year-old, I thought, my dad knows nothing. But when I got to about 30, I realized all you got to do in the markets is know, is it going up or is it going down? And if you don't know either, you shouldn't be playing. Yeah. And if it's going up, well, you want to be long. And if it's going down, you want to be out or short, depending on your psychology. And which way is crypto going right now? It's going down.
Yeah.
And that's obvious. So it doesn't matter what you say. If you say it's going up, well, you should be long. And I think you might, you might be right. And if you think, and there's the other thing that a gold miner taught me when I was up to my waist in freezing water in Scotland gold panning. He said, if you think it's gold, it isn't. If you know it's gold, it is. So if you know it's going up, if you think it's going up, it isn't. If you know it's going up, it is. And you should be long. If you think it's going down, it isn't. And if you know it's going down, you should be out or short. So all you got to know is, you know which way is the market going. You know which way the market's going. If you don't know which way the market's going, and you have to ask my opinion, you shouldn't be in it.
Exactly. And I think that's a good point, because it's not just about, telling people to do their own research and to kind of get skill up, but it's also taking their own risk and say, right, this is what I want to do. And I know there is always a risk, but I'm taking on, because at the end, my assessment result into a market going down or a market going up. And I think that's very important, because we are dealing with gamblers sometimes, and people, they are not really, maybe the gamblers, they actually are aware.
Gamblers lose money. That's what gambling is.
Exactly.
There's staking and there's gambling. Gambling is when the odds are against you, right? And anybody who's gambling loses because the odds are against them. It doesn't matter how you cut it. I mean, I don't care how good a poker player you are. You won't make money playing poker when the rate of the table is 10%, because you have to be so much better than everybody else that even though you're losing 10% of the stake every time you play, you can still get better. So you have to really be a good poker player playing against blind dwarfs if you're going to win with that kind of rake, and that is not going to happen. So gamblers always lose. Yeah, stakers win because they only bet when they only put the money down when they're interested, when the odds are in their favor. So and it's no good expecting someone else to be able to do this stuff for you. It's not that difficult, but it's work, because it's like saying, well, I'm going to play a game of tennis, but I'm going to sit to one side and I've got Djokovic, whatever his name is. I've got Federer on the court, and I'm going to turn to run to the left and hit, run to the right and hit, and run forward and smash. It doesn't matter how good he is. If you're instructing him, he's not going to play his best game, is he?
Exactly. I think that's a fantastic tip that everybody should reflect on. Take power back to yourself. Be aware. Do your own research, but also be aware of the risk you are taking and be confident. I mean, it's not just about investing; it's about everything in life. So I think it's a fantastic.
I think that's totally right. But investing, there's no mummy.
Exactly.
There's no rails to stop you falling out the window. There's no safety net. It's a jungle out there.
Yeah.
And it takes no prisoners. It has no fear. It has no remorse. It does not stop.
Yeah.
And therefore, you've got to. I'm making it sound difficult. Read 5 books, and I don't mean about crazy trading to make a living as a day trader. I mean 5 books about how Warren Buffett does it will do you. 5 books about proven and successful investors. 5 books, and boy, if you can't read 5 books on famous successful investors and how they've made themselves incredibly rich, I mean, really, you shouldn't really be here, should you?
Yeah.
Because that's how can you justify you putting your hard-earned money on the line? But I mean, you go to casinos all day long. There's queues of people putting their money on the red, and everybody knows they're going to lose. And half of them would say, "Oh no, if it comes up 6 times, it's going to come up black 7th," and all that stuff, which is 101 gambling fallacy. But there they are in droves doing it, and that's why casinos are huge towers of steel and glass and give away free cocktails to people silly enough to believe they can win. And don't be that person.
Exactly. Don't be that person. Clem, thank you a lot for this tip. I think is great. And it's good also, even if people know it, sometimes it's good to repeat it and make a point. I know you are super busy with what is going on your end, so I don't want to keep
my end out of it, I say.
Exactly. I know I was just talking to Zach. It looks like it's something that you see is happening to other companies, and then when actually is happening.
No.
But there is a lot going on. That's it. Let's leave it like that. So watch the space. What can we say?
Well, nothing.
Exactly.
And that would be good. Clem,
thank you. Have a lovely week, and thank you everybody for watching. I will see you next.